Are you wondering how much to invest in stocks versus safer investments? This video explores the principles behind age-based asset allocation and also examines different strategies for various life stages. This should also help you gauge how your financial situation and your goals can shape your investment approach beyond simple age-based rules. And remember, if you do enjoy our content, please like this video, and if you haven't already, subscribe to our channel. Let's begin with some core principles. And here's an imaginary person who's age 20. Now clearly this person probably has a very long investment horizon. If they're investing money now for their retirement, then it's very unlikely they'll need that for a long time. That in turn means that their focus is on capital growth. Furthermore, their appetite to risk will be very different to someone who's much older. They can afford to take much greater risk, and if equity markets do crash, this is a huge buying opportunity because what they're doing is buying equity at a discounted value, which will ultimately boost their long-term return once equity markets recover. So generally, this is the reason why younger people tend to have more risky assets with greater long-term capital growth. So we'd expect to find more equity in their portfolio and less things like bonds or cash. And we can contrast that with the same person when they're in their 60s. Now clearly at this point in their life, they've got a much shorter investment horizon. Their focus now is more on capital preservation because they're not going to have such earning power as they had when they were young. And whereas previously crashes in the market were an opportunity, now they're a risk. And the reason for that is that these crashes deplete their savings, which they're no longer able to top up as they could previously with their salary. So generally, we'd expect to see people who are older have less equity in their portfolio and more safe investments, more bonds, more cash, and less risky things. Another way of looking at the same fact is that when someone's young, they have a lot of human capital. That's their future earning power. Whereas as we approach the end of our life, we accumulate greater financial capital and our human capital diminishes as a result of that. So as we invest over the course of our lifetimes, we convert human capital into financial capital. And part of this story is about asset behavior. And this is why asset allocation is important. You have to understand the behavior of assets just as you understand the behavior of your friends. If you invest in stocks, they do generate greater long-term return, but that comes at the cost of greater short-term volatility. They tend to be more crashy than things like bonds, particularly short-duration bonds. So for example, if we track the US S&P 500 over one-year periods since 1988, you can see that it's been very volatile. Over the course of 1 year, you can almost flip a coin to see which way the market will go, although the coin is skewed towards an upward drift, as we'll see later. So historically, there's been a roughly 20% chance that you'll make a loss over the course of a year. And these are total returns and they're not inflation adjusted. So over short periods of time, say 1 year or less, what you're primarily looking at is volatility. Stocks are very volatile, and the shorter the period you look at, the greater the volatility you see. But there's another component to stock return, which is an upward drift, driven by profit growth. So now if we focus on 20-year periods between 1988 and this year, you can see the effect of that upward drift much more clearly. So over longer periods of time, drift beats volatility, signal beats noise. And there hasn't been a single 20-year period since 1988 when equity markets have fallen over these 20-year periods. So that's why if you have a short investment horizon, if you need the money over a short period of time, you're not going to put a lot of it into stocks because they might crash over that period. Whereas if you're not going to be needing the money for a long period of time, well, you can monetize that drift and not really worry about the volatility too much at all. So a commonly used rule of thumb is to do 100 minus your age to work out how much to put into stocks. Now this isn't a great rule, but it is a simple rule, but it captures this idea that when you're young, you start out with a lot of equity, a lot of stocks which are very volatile and which will generate good long-term return. Then as you age, you de-risk your portfolio. And some people call this a glide path. As you age, you generally glide down the risk profile into a safer portfolio. Now, if you're the kind of person that wants to test these ideas out for yourself and take your portfolio and backtest it, then that's an empirical question. And we've created these tools on our website to allow you to do just that. So you can take a portfolio and see how well it would have performed historically. What performance would it have had? What volatility and drawdown would it have had? What does the risk return plot look like? And how are the assets correlated with one another? We've also got a Monte Carlo simulation tool, and this allows you to simulate what that portfolio may look like in the future, taking into consideration the uncertainty of future return. That's both for saving and also in drawdown and retirement. Not only that, but you get access to lots of other goodies like our library of explainers, which we've got hundreds of now, but also our chat application so you can ask me a question whenever you like or ask a question of the community. To learn more about how to become a premium website member, just go to our website, pensioncraft.com/membership to learn more. And there'll be a link to that in the description below. But age is not the whole story. Now, age is related to investment horizon. When you're young, you have a long horizon. When you're older, the horizon shortens. But there are two other critical components to decide how much equity to have in your portfolio. The first one is risk appetite. So that's your emotional capacity for loss. It's your willingness to take on risk. You might be someone who's very young, but very risk averse. It may be that if you lose money on the equity market, then you'll be really distraught by that, in which case it doesn't make sense to have a very risky portfolio. Another component is risk capacity. What's your economic capacity for loss? If equity markets fall by 20%, will that affect your quality of life? So again, if you have a low risk capacity, it wouldn't make sense to take on a lot of equity in your portfolio. So when you're deciding on how much risk to put into your portfolio, how much in stocks, how much in safe investments, then it makes sense to consider all three of these factors. But if I had to choose one which was most important, I'd say it was probably investment horizon, which is driven by age. So now let's step through the lifetime of someone and look in concrete terms at how much they'd put into different investments over the course of their life. And we're going to focus on a set of funds created by Vanguard called Target Retirement Funds. And let's start with your early career where you're just starting to earn. So here you can see the asset allocation of one of those target retirement funds broken down by age and also implicitly time to retirement. So retirement here you can see is the dashed black line. And this is the glide path for the various types of asset in your portfolio if you use one of these target retirement funds. Now when you're age 25, based on the principles we've seen, it would make sense to have a lot of equity. And indeed, this portfolio does. You'd have 80% in stocks and 20% in bonds. And if we look at the split of those investments, you can see that 60% is in global ex-UK equity, and a surprisingly high amount, 20%, is in UK equity, so a total of 80%. The remaining bond allocation is 15% in global ex-UK bonds, hedged into sterling because you don't want a lot of volatility due to currency. You're buying those bonds for safety after all. And then 5% in UK nominal bonds. So those would be UK government bonds, but also UK corporate bonds. Now there's no currency risk because they're denominated in sterling. Then we move on to mid-career. So here I've sliced the graph vertically at 50 years of age and looked at the allocations. Now we have dialed back the equity a little bit, but it has to be said, not a lot. We've still got 75% in stocks and just 25% in bonds. So given that the glide path really hasn't changed much at all, why bother with it in the first place? You could just buy a Life Strategy 80/20 fund, which would match this pretty closely. Or indeed, you could just do it with two funds yourself, a global equity fund and a safe government bond fund. Now we come to a really critical point, which is pre-retirement. The reason why this period is important is that if you have a crash at this point, you've accumulated a lot of wealth usually, and you're very sensitive to a crash. The reason for that is that once you enter retirement, briefly after this period, then if you do have a crash in your portfolio and it doesn't have safe assets to draw on, then you'll end up depleting your pot at a greater rate. If you're taking out a fixed salary from your investments every year and the size of your pot's depleted, then in percentage terms, you'll be depleting it faster. And that shortens the lifetime of your investments. Now, this is called sequencing risk, and it's something you try to avoid. And you avoid it by de-risking your portfolio. So at this point, you can see that you've de-risked quite a bit. 55% is in stocks and the remaining 45% is in bonds. Furthermore, a new category of bond has entered your portfolio, which is inflation-linked bonds. These are linked to the rate of inflation in your country. Now that becomes increasingly important as you age because you don't want bonds which are going to deplete in value over time. You want ones which are linked both in terms of their principal repayments but also their coupons to inflation. So your spending power won't be eroded over time. And then our final stage is retirement. Now you can see that the glide path essentially bottoms out in terms of de-risking when you reach age 75 for this target retirement profile. Notice that now inflation-linked bonds make up almost a fifth of the portfolio because inflation becomes a really important risk factor at this point. The equity component is still there to generate good long-term returns and to beat inflation, but really this portfolio doesn't have much risk in it at all. So I think the target retirement funds are interesting, but I think they have certain problems. I think not everyone will want that glide path. As we'll see in a moment, few people do in fact. Furthermore, there's a lot of research which suggests that having more equity later in life also makes a lot of sense. So de-risking to 30% equity is not going to be appropriate for some people. You may get a much better outcome by taking a different risk profile, a different glide path if you like. Another problem with life strategy is that if there is an equity market crash, then you don't have a choice about which asset to sell when you're doing your withdrawals. Everything is in one fund, which means that if you're selling some of your life strategy fund, you'll be selling the equity, depleted though it is, alongside your bonds. If you do the equity bond split yourself, you do have that option about which one to sell. Clearly, you'd sell the one which hadn't crashed. So that's another problem I have with life strategy funds, alongside the fact that it's got a huge UK bias, which I think historically has just not worked very well at all. The UK equity markets underperform global equity to a shocking degree. Another problem I think is that it's restricted to not having any commodities in the portfolio at all. Now, in an episode of our podcast, Many Happy Returns, we interviewed Tyler, the creator of the website Portfolio Charts, and he talked about the optimal allocation historically, assuming you don't want to run out of money over a 30-year period. And he did some incredibly robust back tests across many developed markets to look at what the safe withdrawal rate was for various portfolios. So what this portfolio does is it looks at the worst possible country and the worst possible 30-year period, which happened to be Japan in the 1990s. Remember, they had that awful property crash and equity market crash then. So this portfolio would have ridden out that awful period in Japan and for every other country in the world as well, even during their worst periods. And it would have sustained a withdrawal rate of 4% per year initially, and then every year after that you'd have inflation adjusted your withdrawals. And that way you wouldn't have run out of money over a 30-year period, even in Japan starting in 1990. The other thing to notice on this graph is the black dot is that safe withdrawal rate portfolio, but he looked at a combination of almost every other asset allocation, and there are 8,008 of those. That's the cloud of points you can see on the graph. And what's interesting is that there are many alternative portfolios which would have given you a comparable outcome. So don't get too hung up on one particular portfolio. It may be that a slight variation is not going to make much difference. But the key thing to notice here is that it's not just about stocks. Stocks make up 40% of the portfolio. And interestingly, there's a big domestic bias here as well. So 10% of that 40% would be domestic stocks, a quarter. But it's also got a big slug of gold, 30%. It's got a big slug of bonds, 20%, but also a broad-based exposure to commodities. Now, Vanguard doesn't have any commodity funds at all. It doesn't have gold. It doesn't have broad commodities. So commodities aren't even included in their glide path. But what this suggests is that perhaps they should be. And finally, let's look at some alternative ideas and strategies. There was an interesting article recently from Vanguard themselves, which looked at what their customers actually do. Do they follow these glide paths when they're investing themselves? And the answer is a resounding no. Far from reducing their equity allocation dramatically just before and after retirement, what we see here is that they've got a glide path which has much more risk in it, particularly towards the end of their lives. Now, what we don't know is whether they hold gilts or other safe investments outside their Vanguard portfolio. Vanguard can only see what they hold on their platform. But I think what this demonstrates is that people are willing to have a greater amount of risk in their portfolio, even towards the end of their life. Now, people are interested in what I do with my investments, and what I do is quite similar to what you just saw most people are doing on Vanguard. For my core investments, I've got 100% invested in a global equity fund, and then what I'm planning to do just before retirement, if I do retire, is to de-risk my portfolio such that I've got a certain number of years of income invested in safe investments. So even if equity markets crash, while they recover, I've got my safe investments to live off. The way I'd work that out, how much to de-risk, would be the income I need for my investments outside my state pension, outside other sources of income like PensionCraft in my case. And then I'd multiply that required income from the portfolio by the number of years I think it'll take for equity markets to recover, maybe 4 or 5 years or a bit less. Now that won't cover the worst outcomes, of course it won't, but it would give equity some time to recover, and in most cases it has recovered over a 3 to 5 year horizon. Now, what would those safe investments be? Well, it could be a gilt ladder, it could be a money market fund, it could be commodities, and it could be gold. And I think I'll keep some of those safe assets just in case in my portfolio after retirement. And the reason for that is that it gives me more choices about things I can sell and a greater chance of having something which won't have crashed if equity markets do fall. Sometimes, remember, bonds and equity fall at the same time, and things like gold, cash, short duration gilts would have allowed me to essentially sell stuff which hasn't. Another alternative is to throw out the concept of age-related investing completely, and all we focus on is investment horizon for the money that we're going to need. Now, if you can create time buckets where you say I'll need this much money at this point in time and add that up over the future years that you're going to be alive, then what you can do is this bucket approach to investing. Anything you're not going to need for 10 years or more would go into the 10-year plus bucket, and the majority of that would be invested in risky things like equity. Volatility isn't such a concern if you're going to be holding that equity for a decade or longer. Money that you're going to need in the next 5 years should be invested in safe things like cash, money market funds, or a gilt ladder, say. And then for the 5 to 10 year bucket, you'll have some mix of risky stuff and combine that with safe stuff. So this lets you work back from when you'll need the money to how to invest it today. Another fascinating concept is called temporal diversification. Now let's look at the shape of most people's portfolios over the course of their life. You start off with nothing, you invest, and then you have this very rapid increase in the value of the portfolio, particularly in those pre-retirement years. That means you're super sensitive to a crash at that point in time. So what you have is concentration in time. Ideally, what you'd do is you'd invest more when you're young. Unfortunately, that's when we don't have much money. So what this strategy suggests is kind of shocking, which is that you have more leverage when you're young. Not only do you invest in risky assets, you lever up those investments. Now, the back tests done in one of these papers, which I'll talk about in a future video in more detail, show that this actually works very well. And what it does is to boost your returns early on so that you're less sensitive to crashes when you reach that pre-retirement few years. The backtests also show that you usually end up with more money at retirement and your pot will therefore last longer. Now, of course, this isn't for everyone. It may be that your risk appetite just can't deal with that leverage. If stocks are scary, leveraged stocks are that much more scary. And scary means crashes and temporary losses. But still, an interesting strategy and one which I'll talk more about in the future. And we'll end with this concept from Clifford Asness, who says you have to do two things. Firstly, you identify a portfolio which has the best risk-adjusted return. Now, of course, 100% equity will have a very good long-term return. Its expected return is higher than you'd get with bonds or with cash or with gilts. But that comes with greater risk, greater volatility. If you combine stocks with bonds, then you end up with more units of return for every unit of risk which you've taken to generate the return. Then the second stage is you have to ask yourself, is the expected return of this portfolio high enough? If it's not, then you lever it up. And there are now funds which allow you to do that. I have talked about them in a video on return stacking. Or, is this portfolio too risky? In which case you can delever it, combine it with more safe assets like cash or money market funds. So I think this is a really interesting take on things from Cliff Asness. He is a grand old man of investment, and it's definitely worth reading his research on the topic. So I hope that's helped you decide how to invest your portfolio based on all of these different factors which drive asset allocation. It's really important to get that mix right, because if the portfolio is not suitable for you, you'll end up with sleepless nights or regrets about return, neither of which is the outcome we want. Now remember, if you did want to join our community and learn more about investing, it's really easy to do that. Just go to pensioncraft.com/membership, and there you'll learn more about what you get. And, as always, thank you for listening.